The objective is straightforward: weaponize a market crash to extract cash from thin air. We do this in 3 steps. First, we siphon the cash. Second, we drop our exposure to the asset. Third, we rotate that capital into fortresses. To execute this, you need 4 specific tools: a brokerage terminal, a target stock approaching its ex-dividend date, a curated watch list of highly defensive fortress stocks, and, above all, the emotional discipline to stick to the numbers when the market panics. When you combine these elements, a bleeding market stops being a threat. Instead, you use the panic as a mechanism to systematically build a high-yield, defensive portfolio without taking on unnecessary risk. Let's look at exactly how this works. Step 1 is what we call the siphon. When a stock crosses the X-date threshold, the company must legally pay you a cash dividend. You don't need to hold the stock forever. You just need to be on the ledger at this exact moment. This FirstMetroSec notice shows the result of that exact trigger. By holding a position in PLUS across its X-date, we passively extracted a cash dividend of 2,763 pesos and 90 centavos directly into the account. We can verify this mechanism works universally. This second notice from a DragonFi account confirms another successful capture on the exact same asset, securing an additional 116 pesos and 20 centavos. The final strike in this sequence involved Petron, or PCOR. This terminal notice details the credit of exactly 675 pesos in cash for holding 5,000 shares across the date. These assets, PLUS and PCOR, were never meant to be long-term investments. In this protocol, they are strictly temporary containers. Their only purpose is to carry us across the threshold to secure the payout. Now that the cash is secured, we move to step 2, the extraction. The moment the dividend obligation is locked in, the container asset has served its purpose, and we must execute a clean exit by unloading the entire position. For the PCOR trade, this meant immediately severing the 5,000 share block. The order executed to sell all shares at exactly 3 pesos and 10 centavos. This immediate exit is a clinical necessity. This chart illustrates what typically happens next. Once the dividend is paid, the stock price often drops sharply. If you hold the asset too long, downward price volatility will completely erase the cash yield you just captured. By severing the position mechanically, you remove any future exposure to that stock's volatility. The underlying asset is gone, but the cash yield remains yours to deploy. With the cash now liquid, we enter the most difficult phase, the vault. This requires strict discipline. It means refusing the urge to immediately reinvest the capital and choosing instead to set on your cash while the broader market bleeds out. Look at this dashboard. The PSEI index hovers near the 6,000 level, and the unrealized loss has expanded to negative 88,896 pesos. But in the top right corner, despite the red, the account holds 86,212 pesos in cash. This is the vault in action. The primary failure point here is trying to catch a falling knife. If you deploy this cash too early, before the market reaches a true psychological floor, you risk trapping your newly acquired capital in a continuing downtrend. Holding cash is an active defensive posture. It preserves your buying power so that when the correction is complete, you can surgically redeploy that capital at a massive discount. Step 3 is the rotation. When the market stabilizes, we use the cash we extracted from the temporary containers to accumulate discounted blue-chip companies, our fortress stocks, like PLTD, trading under the ticker TEL. We executed a precise limit order to rotate the yield into this utility infrastructure, acquiring 10 shares of TEL at exactly 1,269 pesos per share. This requires limit discipline. The operator sets a predetermined blood level price and waits. We refuse to pay a premium to chase green candles. If the market rallies away from our target price, we cancel the order and keep the cash. By executing this transfer, the rotation takes a temporary short-term cash extraction and converts it into a permanent high-yield defensive shield for the portfolio. To recap the protocol, you materialize cash from temporary yield plays, you discard the underlying risk, and you use the resulting capital to fund long-term defensive assets at a steep discount. The portfolio is now fortified. We maintain our defensive positions and continue holding over 86,000 pesos in dry powder, waiting patiently for the next market floor. Maintain the blackout ledger. review the daily audits, keep your cash secure, and wait in silence for the next correction. End of protocol.